Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is John Grady, partner with the law firm Practus, to discuss the latest alternative investments for the institutional and retail investors, as well as an update in how regulators have dealt with COVID-19. John, it's great to have you with us. Welcome back to Trade Talks.
Thank you very much.
All right, John, let's learn more about your background. What viewpoints and experience do you bring to the discussion?
I think it's important to know that I come both as a lawyer and as a person who's run many of the businesses that I now help advise, so that I can not just see what something's being proposed to do or something that might be an idea out there, but how it might impact the businesses that then have to cope with whatever has been proposed.
Let's spend some time on retail investors. What can they expect in the coming months from the industry and the regulators? Will alternatives start to show up in retirement accounts?
So it's interesting. I was going to talk about, for example, Reg BI, which is at this point ancient history, right? It came out on June 30th as an effective regulation. It means you have to get more information from your broker dealer than ever before on what they do for you, how they charge you, what their conflicts might be. But as I said, that's going to result in new forms coming your way when you're an investor. But also the SEC just proposed new thoughts around an annual report on your mutual fund. And many people own them through either directly or mutual fund through their retirement accounts. And they're going to get an annual report that is more summary, more colorful, more interesting, maybe even more simplified, and pushing some of the financial information into the background, instead focusing on comparative information, focusing on how the fund did against benchmarks, to try to help an investor understand, is my fund doing well, is my fund doing poorly, both absolutely and in relative terms. Now, that just was announced on Wednesday. It's going to be put out as a proposed rule starting today. It'll get comment, and there'll be a chance to think about either changes or additions. But the fact is, folks at the SEC are hard at work, notwithstanding the pandemic, trying to think of ways to make the slew of paper that everybody gets in their mailbox and wishes they had less of, how to make the paper they do get more useful, more relevant.
Let's talk about semi-transparent ETFs. It seems a bit counterintuitive because the financial industry is always looking at ways to become more transparent.
Right. This is the case where there are strategies that managers know and have run in mutual funds and separate accounts, that if you told the street what you were going to do ahead of time or in real time, folks would basically follow you, pick you off, the way that people will try to follow a Berkshire Hathaway, for example. They could basically follow or dog the footsteps of the manager, and in doing so, either interfere with the manager's ability to execute, or maybe make it more expensive, for example, to get in to a position because they've already crowded in before the manager's finished even getting half of its order through. That kind of transparency, we all recognize, is not to anyone's interest. So what the new semi-transparent ETFs do is they provide a lot of transparency, but not as much as the traditional model, in the thought that we can balance. We can balance what investors need and what the arbitrage community needs to make ETFs trade well, but then, in a sense, hide some of the really in-motion strategies long enough to allow them to be executed before the general public, the investing public, the arbitrageurs, the market can see what was done. And in that sense, kind of protect them from being picked off the way they would if they were just visible from the minute they were introduced.
What's going on with offering reforms in the accredited investor standard?
So folks are looking at ways of, it's interesting, it's a balance. They're looking at ways to make sure that those who are picked up by the definition really have the sophistication to take care of themselves, because the securities laws put a lot less emphasis on protecting those investors from the offer, from sort of understanding how it works, than they do offerings made to retail investors. So for accredited investors, there's been a thought we should index it, right? That number has been around since 1982. Although it was adjusted to take out your house some years ago, which made a big dent in the number of people who meet the $1 million net worth test. But now, as opposed to trying to let more people in through either adjusting the net worth or income tests, people are focusing instead on letting them in because they're accredited by virtue of degrees, experience. So a broker dealer can come in as an accredited investor irrespective of their wealth. Certain people who are in this business who have certain degrees. So it's proposed that those people will come in addition to those who come in either by wealth or by income.
What's involved with the SEC's proxy voting reform? Starting to hear a lot about that.
You are, and you'll hear more about it. essentially the SEC took the step, and I think many were grateful that they did something, because it had become a fairly closed circle. The folks making decisions at the proxy advisory service firms were essentially calling the outcome of shareholder meetings because of how many advisors, how many fiduciaries relied on their advice in how to vote their shares. And what the SEC is forcing those same, particularly fiduciaries, to do is to really look very much at what kind of methodology the proxy firm uses and make sure that they understand how it works, and maybe even have to provide more of their own input into the decision-making process and less just kind of defaulting to what the proxy service is going to recommend. What that does is it takes some of the sort of the outcome control away from the proxy services firms, and it puts it back in the hands of those who are voting, fiduciaries as well as individual investors who own the shares. The problem is folks have gotten very accustomed to being able to take the process of voting out from underneath their roof and put it at the proxy voting service. And now they're gonna have to take some of it, if not a lot of it, back and start being involved once again in the corporate governance side of what they own. I think it's a good change for the marketplace, but it's a lot of work, and there's a lot of folks who are upset because it either changes the way things are and they like the way things were, or it puts work on them that they didn't have.
John, prior to COVID-19, the focus really was on ESG before everyone had to pivot and figure out what work from home looks like and reevaluate how their businesses operate. Do you think ESG funds will regain that momentum, and it's something that's going to go mainstream and a trend that's here to stay?
You know, it's interesting. Yes, I think they're here to stay. Yes, I think they've gone increasingly mainstream. But one place they may lose some of that momentum is in your retirement account, particularly if you're a fiduciary who's managing a number of managers and you're choosing managers to run money for the pension plan. The Department of Labor, a regulator we don't always talk about when we talk about financial services, but the Department of Labor really regulates pension arrangements, in particular the large pension plans that invest in all kinds of individual stocks through managers that may have felt interested, if not, in fact, more than interested in bringing an ESG strategy forward. Now, under the proposed rule, again, it's not final, they would have a lot harder time demonstrating that the ESG benefits offset any potential downside to ESG. Now, that's a really sophisticated argument. I don't want to have time or the ability to go into it now, but essentially, what is going on is ESG folks are saying you need to consider these other elements of an investment in addition to pure return. You need to think about the impact of the, some of the energy issues that create what many believe to be outsized amounts of pollution, for example, with respect to the value that they produce. The ESG movement would say, well, you should really invest less in those industries because they're not really, they're not favoring the environmental social governance policies underlying ESG. Now the Department of Labor would say you have to basically make sure, best as you can tell in advance without any firsthand knowledge, that those other factors don't undermine the performance of the investment. So we're seeing a real shift away from ESG being a benchmark that pension managers can use, and back to being something that really can be a plus if you otherwise have neutral factors. That's a very big change that's going on at the same time that retail investors are demanding more and more ESG in their mutual funds and in their private account investments.
All right, John, great insight as always. Thanks for joining me on Trade Talks.
Okay, thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.